Tonight, our topic is the evolution of money, from simple barter to the systems that shaped civilizations. As you gently drift into sleep, let this quiet journey through history unfold slowly and calmly in the background. Money is such a basic part of life and has become so familiar to us that we tend to take it for granted. We never stop to think how money came into being, what it really represents, or why we choose to proffer it for the things which surround us in the various forms that our culture has molded it into. But over thousands of years, humans developed a form of barter, the predecessor of trade, and created currencies as a means of exchange. In theory, money is just a medium of customer exchange, a unit of account, or a store of value. These abstract motifs have been projected onto an amazing array of stuff, and now, increasingly, onto immaterial representations since time began. To decipher the history of money, we first have to look not at money, but at economic systems before there was any such thing, because money wasn't born in a vacuum. It evolved as a means to solve certain problems that faced human economies. Tribal societies, in which a few dozen to a few hundred members made their living together, hunting and gathering, had little use for anything that we would call money, because economic life revolved around sharing and reciprocity within the group. The successful hunter who felled an especially large animal would share the meat with other members of his band, not because he owed them anything in a contractual sense or anticipated any quid pro quo, but for the simple reason that sharing was customary within the group, and because everyone recognized that times changed and roles reversed. For suddenly, the tables might turn on him, and he would be in want of their help. Such generalized reciprocity worked fine in small groups because nobody wanted to be ostracized, so reputation and social relationships were paramount. But it simply didn't scale to larger societies or more arm's-length transactions. As complex societies developed in the wake of agriculture and settlement, so too did systems of exchange, with reciprocal sharing no longer being enough as economic interactions grew more varied and common. People started to specialize in different things that produced something, so one person was farming while another was herding, and someone else was making pots or tools or textiles. This specialization made exchange necessary because the farmer who grew grain needed pots to store it in, the potter needed grain for food, and farmers both needed and had plenty of implements to work with. The most straightforward form of exchange is barter, a type of transaction in which two parties offer to trade goods or services directly for one another without the use of any medium of exchange. And barter did occur and may continue in limited circumstances. Yet barter is very limited as a means for organizing an economy. The single greatest obstacle to any kind of barter is what economists call the double coincidence of wants. That is, for a barter transaction to take place, both sides have to happen to want what the other has, and also happen to have what the other side wants at precisely that time. If the farmer wants a pot, but the potter does not want grain at that particular moment, no exchange can occur, even though both parties might benefit from trade. The farmer would have to find someone who wants grain and who has something the potter wants, and then arrange a multi-party exchange, which quickly becomes complicated. Another problem with barter is the difficulty of establishing fair exchange rates between different goods. How many pots is a sheep worth? How much grain should be exchanged for a bronze knife? Without a common unit of value, every exchange requires negotiation about relative values, and there is no easy way to accumulate wealth in a form that can be stored and used for future exchanges. These limitations of barter created strong incentives for the development of some form of money that could serve as a universal medium of exchange. The earliest forms of money emerged independently in different societies around the world and took many different physical forms depending on what was available and valued in each society. But certain common characteristics appear across most early monetary systems. The objects used as money needed to be durable so they would not spoil or deteriorate, quickly portable, so they could be easily transported, divisible, so that different values could be represented, uniform, so that units were interchangeable, and scarce enough that they retained value, but not so rare that insufficient quantities were available for use in trade. Additionally, the objects used as money typically had some intrinsic value or usefulness beyond their function as money, though this intrinsic value component became less important over time as money became more abstract. In Mesopotamia, one of the earliest civilizations, barley and silver were used as standards of value and media of exchange as early as the 3rd millennium BC. Barley was a staple grain that everyone needed and that could be stored for some time, making it suitable as a medium of exchange, though its bulk and perishability limited its usefulness. Silver, being valuable, durable, and relatively rare, was more suitable for larger transactions and for storing wealth. The Code of Hammurabi from the 18th century BC specifies prices and fines in weights of silver, indicating that silver had become a standard unit of account, even though actual transactions might be conducted using various goods. In ancient China, cowrie shells served as an early form of money, being small, durable, attractive, and relatively scarce, since they came from the ocean and had to be transported inland. The Chinese character for money or valuable still resembles a cowrie shell. Later, bronze cowrie shells were cast to supplement the natural shells, representing an important step toward abstract money that did not rely on the intrinsic value of the material. In various parts of Africa, goods used as money included cattle, iron hose, copper crosses, salt bars, and cloth, with the specific form varying by region and culture. Cattle were particularly important in pastoral societies, where they represented wealth and could be used for various purposes, including producing milk and pulling plows, in addition to serving as a medium of exchange. The Pacific Islands also used shells, stone discs, and other items as money. The legendary rye stones of Yap, some up to several meters in diameter, functioned as currency, even though it would have been impossible to transport them every time something was purchased. Instead, ownership of the stones would transfer while they stayed where they were. One of the earliest known forms of money to be a social construct rather than something that had to be physically moved. Across the ancient world, a wide-ranging selection of commodities were used as money, such as grain, cattle, hoes, and sickles, pans, and weapons. Shells, which created the first problem in establishing fair trade practices, were also common, along with beads made of glass or ceramic material, gold, and silver pieces, a practice mostly associated with monetary transactions on an institutional level, and other items. The consideration of gold and silver as money would be especially important and would reign supreme for millennia. Gold and silver had several advantages over other monetary metals. They were much rarer, so small quantities could be worth large amounts. They also had a lower melting point, making the coins easier to produce than those of copper or tin. The quality of metal used was more consistent throughout their coinage than it was with copper or tin. And lastly, while other metals tarnished, gold or silver did not. Originally, metal was traded by weight, so pieces of metal could be weighed for exchange. This was awkward and made it easy for criminals to make money through the use of false weights, or by alloying cheap metals with more desirable ones to gain weight without adding value. The invention of coin currency in the 7th century BC is a similar development, making money easier to handle and changing its nature. The first money was made in the kingdom of Lydia, in what is now Western Turkey, when King Alyattes, or his son Croesus, minted the first coin around 600 BC. These early coins were struck in electrum, a naturally occurring gold-silver alloy that can be panned from the river. The innovation was to stamp a design or mark into the circular piece of metal with some kind of authority, who then guaranteed that weight and purity. The need to weigh and assay metal for each transaction was no longer necessary, since the users could accept coins at face value on faith in the issuing authority. This dramatically simplified transactions, cutting the cost of doing business and freeing trade to flourish. The concept of the political or even belligerent use of coinage also spread from ancient Greece throughout the ancient world. Each of these Greek city-states would produce their own coins, which bore the symbols and images special and particular to that city-state. The Athenian coin, carrying the owl of Athena, the patron goddess of the city, became one of the most widely accepted for trade in the Mediterranean Sea due to their volume and value. Standardized designs and weights, through their effect on the appearance of coins on both sides of trade transactions, made money a familiar and reliable medium. The Greeks also developed sophisticated monetary concepts, including the establishment of exchange rates between different coinages, the operation of money changers who would exchange coins of different cities, and the beginnings of banking activities, including accepting deposits and making loans. The Romans adopted coinage from the Greeks and expanded its use throughout their vast empire. Roman coins became the standard currency across much of Europe, North Africa, and the Near East, facilitating trade and economic integration across this huge area. The denarius, a silver coin introduced in the 3rd century BC, became the standard coin of the Roman Empire and remained in use for centuries. Roman coins were not just economic instruments, but also political tools, with emperors using coins to disseminate their images and messages throughout the empire. Coins bore portraits of emperors, images of military victories, depictions of gods, and inscriptions proclaiming various achievements or virtues. Since coins circulated widely and were handled frequently, they served as a form of mass communication, spreading the emperor's image and propaganda to even the most remote corners of the empire. The production of coins required sophisticated organization and technology, with mints established in various cities to produce coins in large quantities. Dies were carved with the designs to be stamped onto the coins. Metal was melted and formed into blanks, and the blanks were stamped between two dies to impress the design on both sides. Quality control was important to maintain trust in the currency, and the punishment for counterfeiting was severe. Despite these measures, the temptation to debase the currency by reducing the precious metal content while maintaining the face value of coins was difficult for rulers to resist, especially when they needed money to finance wars or other expenses. The Roman Empire experienced significant inflation and currency debasement, particularly in the 3rd century AD, when economic and political crises led emperors to repeatedly reduce the silver content of coins. The denarius, which had originally been nearly pure silver, was reduced to less than 5% silver by the late 3rd century, becoming essentially a bronze coin with a thin silver coating. This debasement undermined confidence in the currency and contributed to economic disruption. The eventual collapse of the Western Roman Empire in the 5th century AD brought significant changes to monetary systems in Europe, with the fragmentation of political authority leading to the fragmentation of currency systems. In medieval Europe, coins continued to be the primary form of money, but the absence of a single imperial authority meant that coins were issued by numerous different rulers, including kings, nobles, bishops, and cities, each with their own standards and designs. The quality and reliability of these coins varied considerably, and money changers played an essential role in facilitating trade by exchanging different coinages and assessing their relative values. Gold coins became rare in early medieval Western Europe as gold supplies dwindled and as the disruption of long-distance trade networks reduced access to gold from Africa and the East. Silver pennies became the standard coin in much of Europe, with the Carolingian penny introduced by Charlemagne in the late 8th century, setting a standard that would influence European coinage for centuries. These pennies were relatively small silver coins suitable for everyday transactions. Larger transactions might be calculated in pounds or marks, which were units of account representing specific weights of silver rather than actual coins. The famous pound sterling of England originally represented 1 pound of sterling silver, though the actual coins were pennies. In the Byzantine Empire, which was the continuation of the Eastern Roman Empire, gold coinage continued with the solidus introduced by Constantine in the 4th century, remaining a stable and widely accepted gold coin for centuries. The Byzantine solidus was used in trade throughout the Mediterranean and beyond, and set a standard of quality that made it a preferred currency for international transactions. The Islamic world, which expanded rapidly in the 7th and 8th centuries AD, developed its own sophisticated monetary system based on gold dinars and silver dirhams following Islamic law regarding weights and purity. Islamic coins initially bore no images of living beings due to religious prohibitions against idolatry, and instead featured calligraphic inscriptions including religious formulas and the names of caliphs and rulers. Islamic merchants operated extensive trading networks stretching from Spain to China, and their coinages circulated widely, facilitating this trade. The adoption of paper money was another revolutionary development in the evolution of money, emerging first in China during the Tang Dynasty in the 7th century AD and becoming widespread during the Song Dynasty in the 10th and 11th centuries. The development of paper money in China was driven by several factors, including the inconvenience of transporting large quantities of coins, especially for long-distance trade, the shortage of copper for making coins, and the sophisticated administrative capacity of the Chinese state, which could issue and manage paper currency. The first paper money took the form of promissory notes issued by merchants and later by government agencies, which could be exchanged for coins at designated locations. These notes were essentially receipts for deposits of coins that could be transferred to others and redeemed later. The government eventually took over the issuance of paper money and made it legal tender, meaning it had to be accepted for payment of debts and taxes. Chinese paper money featured elaborate designs and seals to prevent counterfeiting and was backed initially by reserves of precious metals, though this backing eroded over time as governments printed excess quantities of money, leading to inflation. The Chinese experiment with paper money was not always successful, with periods of hyperinflation occurring when governments printed too much money to finance military campaigns or other expenses. But despite these problems, paper money remained an important part of the Chinese monetary system for centuries. European travelers to China, including Marco Polo in the 13th century, were amazed to find that the Chinese used paper as money, a concept that seemed remarkable to Europeans accustomed to precious metal coins. The Mongol Empire, which conquered much of Asia in the 13th century, including China, adopted and extended the use of paper money throughout its territories, creating a unified paper currency system across a vast area. European adoption of paper money came much later than in China, with the first European paper money appearing in Sweden in the 17th century and gradually spreading to other countries. The development of paper money in Europe was closely linked to the development of banking, which had evolved considerably during the medieval and early modern periods. Medieval banking originated in Italy, where merchant families, including the Medici of Florence, engaged in banking activities, including accepting deposits, making loans, exchanging currencies, and transferring funds between cities through letters of credit. These letters allowed merchants to deposit money in one city and withdraw it in another without having to transport actual coins. These banking services facilitated long-distance trade and made bankers wealthy and influential. The Knights Templar, a military religious order, also engaged in banking activities, managing funds for pilgrims and crusaders traveling to the Holy Land. The development of double-entry bookkeeping in medieval Italy provided a systematic method for tracking financial transactions and keeping accurate accounts, which was essential for sophisticated banking operations. As banking became more established, banks began to issue notes promising to pay the bearer a specified amount of money on demand. These banknotes were essentially IOUs that could circulate as money, being transferred from person to person with the understanding that they could be redeemed for coins at the issuing bank. The convenience of paper notes compared to heavy coins led to their increasing acceptance, but the value of banknotes depended entirely on the trustworthiness of the issuing bank and on the bank's ability to redeem notes for coins when demanded. Banks that issued more notes than they could redeem if all holders demanded redemption simultaneously were vulnerable to bank runs, where panicked depositors rushed to withdraw their money, causing the bank to fail. The history of banking is filled with bank failures and financial crises resulting from imprudent issuance of notes, risky lending, or simple fraud. The concept of fractional reserve banking, where banks hold reserves of precious metal or other assets amounting to only a fraction of the value of notes in circulation, developed gradually as banks realized that in normal circumstances, only a small percentage of note holders would demand redemption at any given time. This allowed banks to issue more notes than they could redeem if everyone tried at once. This created both opportunities for expanding the money supply to facilitate economic activity and risks of financial instability if confidence was lost. Governments eventually began to regulate banking and currency issuance more closely, and many countries established central banks that had exclusive or primary rights to issue paper currency. The Bank of England, founded in 1694, became a model for central banking, initially operating as a private institution, but gradually acquiring special privileges and responsibilities, including managing the government's finances and regulating the money supply. The Bank of England's notes eventually became the dominant currency in Britain, and in the 19th century, the British government made Bank of England notes legal tender that had to be accepted for all debts. Similar developments occurred in other countries, with central banks being established and taking on responsibility for monetary policy and currency issuance. The question of what backed paper money and what gave it value was crucial to monetary debates for centuries. In the early stages of paper money, notes were backed by precious metal reserves held by the issuing bank or government, with note holders having the right to exchange notes for gold or silver on demand. This convertibility into precious metal meant that the value of paper money was tied to the value of gold or silver, and the money supply was ultimately limited by the availability of these metals. The gold standard, which became widespread in the 19th century, formalized this relationship by defining the value of national currencies in terms of fixed quantities of gold and by allowing free conversion between paper money and gold. Under the gold standard, a country's money supply was constrained by its gold reserves, and international trade imbalances would automatically adjust through flows of gold between countries. The gold standard provided stability and predictability to international monetary relations and facilitated the expansion of international trade in the 19th century, but it also imposed constraints on governments' ability to respond to economic downturns by limiting their ability to expand the money supply. The Great Depression of the 1930s brought the classical gold standard to an end as countries facing economic collapse abandoned gold convertibility in order to have more flexibility in monetary policy. The United States abandoned the domestic gold standard in 1933, though gold continued to play a role in the international monetary system. After World War II, the Bretton Woods system established a modified gold standard where the US dollar was convertible to gold at a fixed rate, and other currencies were pegged to the dollar, creating an international monetary system based on fixed exchange rates. This system worked reasonably well for several decades, but came under increasing strain in the 1960s and early 70s as US gold reserves declined and as confidence in the dollar's value wavered. In 1971, President Nixon ended the convertibility of the dollar to gold, effectively ending the Bretton Woods system and ushering in the modern era of fiat money, where currencies have no backing in precious metals and derive their value solely from government decree and public confidence. Fiat money represents the ultimate abstraction of the money concept, where the physical form of money is irrelevant to its value, and where the only thing that matters is acceptance. Modern paper money and coins are worth far less as materials than their face values, but they function as money because governments declare them to be legal tender and because the public accepts them in transactions, trusting that others will also accept them. This trust is maintained through various means, including legal requirements to accept currency for payment of debts, the government's own acceptance of currency for payment of taxes, central bank policies aimed at maintaining stable prices and preventing inflation, and the sheer convenience and ubiquity of government-issued currency. The transition from commodity money with intrinsic value to fiat money with only nominal value occurred gradually over many centuries and represented a fundamental change in the nature of money. The development of electronic money in the late 20th and early 21st centuries represents another revolutionary change in how money functions. Electronic money began with the adoption of computer systems by banks in the 1950s and 60s, which allowed accounts to be maintained electronically and transactions to be processed without physical movement of cash. The development of credit cards in the mid-20th century created a form of payment that was essentially a convenient way to access credit extended by banks, with cardholders borrowing money to make purchases and then repaying the credit card company. Debit cards, which directly access funds in a bank account, became widespread in the late 20th century, allowing electronic payments without the extension of credit. Automated teller machines, or ATMs, provided convenient access to cash and account information, reducing the need to visit bank branches. The spread of the internet in the 1990s enabled online banking and electronic payments, allowing people to transfer money and pay bills without handling physical cash or checks. Payment systems like PayPal emerged to facilitate electronic payments for online purchases. Mobile payment systems using smartphones became common in the 21st century, allowing payments to be made with a tap of a phone. In some countries, mobile payment systems have largely replaced cash for everyday transactions, with people using their phones to pay for everything from groceries to taxi rides. The movement toward a cashless society, where all transactions are conducted electronically, is well advanced in some countries, though cash remains important in many places. Electronic money has several advantages over physical cash, including convenient security against theft and loss, the ability to track transactions and ease of use for online and long-distance transactions, but it also raises concerns about privacy, since electronic transactions leave digital traces about exclusion of people without access to banking and technology, and about vulnerability to technical failures and cyber attacks. The emergence of cryptocurrencies in the early 21st century represents perhaps the most radical innovation in money since the invention of coinage. Bitcoin, the first cryptocurrency, was introduced in 2009 by an anonymous person or group using the pseudonym Satoshi Nakamoto. Bitcoin and other cryptocurrencies are virtual currencies that exist only as entries on a digital ledger called a blockchain. There's nothing physical to hold or touch, and no bank, credit card company, or government controls them. The blockchain uses special cryptographic techniques to verify every transaction. This also protects the digital currency from being copied or spent twice. It solves the double spending problem, which for a long time prevented purely digital money from working without a trusted central authority. Because cryptocurrencies are decentralized and separate from any government or central bank, they appeal to people who don't trust their monetary authorities. They also attract those who want to make transactions that are hard for those authorities to track. You can send cryptocurrency directly from one user to another, anywhere in the world, without needing intermediaries like banks or payment services. This can help you avoid remittance fees and other charges. However, cryptocurrencies have serious limitations holding them back from being used just like regular money. Their value is incredibly volatile and can fluctuate wildly, which means they aren't a great store of value or a stable unit of account. Processing transactions can also be slow and costly, especially when demand is very high. For most cryptocurrencies, the number of transactions that can be processed at once is limited by design, but even without this limit, it would be impossible to scale up to the number of transactions needed if a cryptocurrency were used as everyday money. Another major issue is the massive amount of electricity consumed in cryptocurrency mining, the process of creating new coins and verifying transactions. This raises significant environmental concerns. Plus, there's a lot of regulatory uncertainty. Many countries are still figuring out the legal status of cryptocurrencies, how to tax them, and how to regulate them. Even so, cryptocurrencies have already gained tremendous attention and trust. They've forced central banks and governments to think about how digital technologies could be used for traditional currencies. In fact, a few central banks are now exploring their own digital currencies, often called CBDCs, or central bank digital currencies. A CBDC would be an electronic version of real money, backed by a government and its reserves. CBDCs could offer the benefits of cryptocurrencies, like fast electronic payments, but without the currency risk that comes with private sector cryptos. This also brings up important questions about privacy, financial inclusion, and the role of commercial banks. Imagine a world where people hold digital currency accounts directly with their central bank instead of at a commercial bank. What would that look like? The evolution of money is a fascinating story. We've gone from cowrie shells and barley to precious metal coins, then to paper money, and now to electronic accounts. The next step could be digital money issued by central banks or decentralized cryptocurrencies. As we move forward, the physical form of money becomes less important, while the social conventions and trust behind it become everything. Throughout this evolution, certain core functions of money have remained constant, including its role as a medium of exchange that facilitates transactions, its role as a store of value that allows wealth to be saved and transferred across time, and its role as a unit of account that provides a common measure for pricing goods and services. The specific forms that money has taken have varied enormously across different societies and time periods, but the underlying need for some form of money to facilitate economic exchange has been nearly universal in human societies beyond the smallest and simplest. The future of money remains uncertain, with various possible trajectories, including continued dominance of fiat currencies issued by central banks, increasing use of private digital currencies and cryptocurrencies, development of central bank digital currencies, or perhaps some hybrid system combining elements of different monetary forms. Whatever forms money takes in the future, it will continue to play a central role in economic and social life as it has for thousands of years. As this extensive examination of the evolution of money draws to a close, we can reflect on how this seemingly simple concept has actually involved complex and fascinating developments over millennia, with innovations in monetary systems often being closely linked to broader economic, political, and technological changes. The invention of coinage facilitated trade in the ancient world and helped create the first large-scale market economies. The development of banking and paper money enabled the commercial revolution and the age of exploration and colonization. The establishment of central banks and modern financial systems supported industrialization and economic growth. The movement toward electronic and potentially digital money reflects the ongoing digitization of modern life. Throughout all these changes, money has remained a fundamentally social and psychological phenomenon, depending on trust and shared conventions for its value and functioning. the physical form of money matters less than the social agreement to use it as money. This is perhaps most clear in the case of fiat currency, which has no intrinsic value but functions because everyone agrees to accept it, and in the case of electronic money, which exists only as bits in computer systems but can be used to purchase real goods and services. As you rest here, after this lengthy journey through monetary history, from the earliest commodity money to the latest digital innovations, you might find that the accumulation of information about coins and paper and banks and digital ledgers has created a kind of mental fog where the specific details blur together. However, there is much more to explore about the evolution of money and its impact on human civilization. So let us continue our examination with greater attention to specific developments and their consequences. The role of money in facilitating economic specialization and the division of labor cannot be overstated, for without money or some similar mechanism for conducting exchange, individuals would need to produce everything they consumed or engage in cumbersome barter arrangements. Money allows people to specialize in producing goods or services in which they have comparative advantage or particular skills, sell their products for money, and use that money to purchase whatever else they need from others who have specialized in producing those things. This specialization increases overall productivity and prosperity, as people can focus on what they do best rather than trying to be self-sufficient generalists. The development of money thus enabled the emergence of complex economies with extensive trade networks and high levels of specialization. The relationship between money and power has been intimate throughout history, with control over money creation and monetary policy being important sources of political and economic power. Rulers who controlled mints and the production of coins could profit from seigniorage, which is the difference between the face value of coins and the cost of producing them. Essentially, a form of taxation that was less visible and perhaps less politically sensitive than direct taxes. Debasement of currency by reducing precious metal content while maintaining face value allowed rulers to increase their spending power in the short term, though it undermined the currency's value and led to inflation. Modern governments and central banks similarly derive power and revenue from their monopolies on currency creation, though in more sophisticated ways than ancient rulers simply melting down coins and reissuing them with less precious metal. The creation of new money, whether through printing paper currency or through the operation of fractional reserve banking, where banks lend out more than they hold in reserves, can stimulate economic activity by making more purchasing power available, but it can also cause inflation if the money supply grows faster than the real economy. The trade-off between stimulating growth and maintaining stable prices is a central concern of monetary policy. Inflation, which is the decline in the purchasing power of money over time, as prices generally increase, has been a recurring phenomenon throughout monetary history with various causes and consequences. Inflation can result from excess creation of money, from increases in the velocity of money, meaning how quickly money changes hands, from cost push factors, where rising production costs lead producers to raise prices, or from demand pull factors, where strong demand for goods and services pushes prices up. Moderate inflation is generally considered normal and even desirable in modern economies, as it encourages spending and investment rather than hoarding money, which loses value over time. But high inflation or hyperinflation can be devastating, destroying savings and disrupting economic activity. History provides many examples of hyperinflation, including the German hyperinflation of the early 1920s, when the German mark became essentially worthless, and people needed wheelbarrows full of currency to buy basic goods, and the more recent hyperinflations in Zimbabwe and Venezuela, where governments printed excessive amounts of money, leading to prices doubling every few days or even hours. Deflation, which is the opposite of inflation and consists of a general decline in prices and an increase in the purchasing power of money, might seem desirable, but can also cause economic problems by encouraging people to delay purchases expecting prices to fall further by increasing the real burden of debts, which become more expensive to repay as money becomes more valuable, and by making it difficult for businesses to cover their fixed costs. The Great Depression was characterized by severe deflation, which exacerbated economic contraction. Central banks in modern economies generally target low positive inflation rates, typically around 2% annually, as a balance between the problems of inflation and deflation. The international dimensions of money and monetary systems have become increasingly important over time as trade and financial flows across national borders have expanded. In the ancient and medieval worlds, different monetary systems coexisted with merchants and money changers, facilitating exchanges between currencies based on the precious metal content of coins. The expansion of European colonialism beginning in the 15th century led to the establishment of European monetary systems in colonies around the world, and to increased flows of precious metals, especially silver, from the Americas, which significantly impacted global monetary systems. The massive influx of silver from Spanish colonies in Mexico and Peru into Europe in the 16th and 17th centuries caused inflation throughout Europe, and as this silver spread through trade networks into the Middle East, India and China, it affected monetary systems and price levels across much of the Old World. The 19th century saw increasing international monetary integration with the widespread adoption of the gold standard, creating a system where major currencies were defined in terms of gold and were mutually convertible through gold, facilitating international trade and investment. London became the center of international finance, with the pound sterling serving as the primary international currency and British banks financing trade and investment around the world. The international gold standard broke down during World War I as countries suspended gold convertibility to finance war expenditures, and attempts to restore it in the 1920s were only partially successful and ultimately failed during the Great Depression. The Bretton Woods system established after World War II created a new international monetary order, with the US dollar playing a central role as the primary reserve currency held by other countries and used for international transactions. This dollar-centered system reflected the economic dominance of the United States after the war and was facilitated by US willingness to maintain gold convertibility of the dollar. The International Monetary Fund and the World Bank were created as part of the Bretton Woods system to promote international monetary cooperation, provide short-term lending to countries experiencing balance of payments problems, and support economic development. The collapse of the Bretton Woods system in the early 1970s led to the current international monetary system, characterized by floating exchange rates, where currency values are determined by market forces rather than being fixed by government agreement, though governments and central banks still intervene in foreign exchange markets to influence exchange rates. The US dollar has remained the dominant international currency used for invoicing international trade, for holding foreign exchange reserves, and for denominating international debt, though the euro, the yen, and other currencies also play roles. The dominance of the dollar gives the United States certain advantages, including the ability to borrow more easily and cheaply, and the ability to use access to dollar-denominated international financial systems as a tool of foreign policy through sanctions. Some countries have sought to reduce dependence on the dollar by promoting alternative currencies or by developing bilateral payment arrangements that bypass the dollar-denominated system. The role of banks and financial intermediaries in monetary systems deserves closer examination, because banks do not simply store money and facilitate transactions, but actually participate in money creation through the process of lending. When a bank makes a loan, it creates a deposit in the borrower's account, which the borrower can spend, effectively creating new purchasing power. If banks lend conservatively based on sound assessment of borrowers' ability to repay, and if they maintain adequate reserves to meet withdrawal demands, this credit creation can support productive economic activity by channeling savings from depositors to borrowers who can use the funds for investment and consumption. However, banks can also lend recklessly, creating excessive credit that fuels asset bubbles and inflation, and banks are vulnerable to runs where depositors lose confidence and rush to withdraw funds, causing the bank to fail even if its assets would be adequate to cover liabilities if given time to liquidate them in orderly fashion. The history of banking is punctuated by periodic crises, including bank runs, bank failures, and financial panics that have caused severe economic disruption. The Panic of 1837 in the United States saw hundreds of banks fail. The Panic of 1873 triggered a severe depression. The financial crisis of 2008, which began with problems in the U.S. housing market and mortgage lending, spread throughout the global financial system, causing the worst economic downturn since the Great Depression and leading to massive government interventions to prevent complete financial collapse. These recurring crises have prompted various regulatory responses, including the establishment of central banks as lenders of last resort that can provide emergency liquidity to banks during crises, the implementation of deposit insurance to protect small depositors and reduce the incentive for bank runs, the imposition of capital requirements that mandate banks hold certain amounts of equity relative to their assets to absorb losses, and various other prudential regulations intended to promote financial stability. The effectiveness of financial regulation is debated, with some arguing that regulations are necessary to prevent excessive risk-taking and protect the public, while others argue that regulations are often counterproductive, fail to prevent crises, and impose costs that reduce economic efficiency. The global financial crisis of 2008 led to significant new regulations in many countries, including the Dodd-Frank Act in the United States. But debate continues about whether these regulations are adequate or excessive. The development of various financial instruments and markets beyond simple money and banking has greatly expanded the complexity of monetary and financial systems. Bills of exchange, which are promises to pay a specified amount at a future date, were used in medieval trade to facilitate transactions across distances and time. Government bonds, which are debt instruments issued by governments promising to repay borrowed funds with interest, became important in financing government expenditures, especially during wars, and the buying and selling of bonds in secondary markets created bond markets that allowed investors to trade these debt instruments. Corporate stocks, representing ownership shares in companies, emerged as a way for companies to raise capital, and stock markets developed where these shares could be traded. The development of these financial markets increased the liquidity of financial assets, provided mechanisms for pricing risk and return, and created opportunities for diversification and for channeling savings to productive investments. Futures contracts, options, and other derivatives that derive their value from underlying assets or variables have been developed for various purposes, including hedging risks and speculating on price movements. The complexity of modern financial systems, with their intricate web of institutions, instruments, and markets, far exceeds what would have been imaginable to earlier generations. But the fundamental functions of facilitating exchange, providing credit, and allocating capital remain central. Money's role as a store of value and its relationship to other stores of value, particularly real assets like land, commodities, and productive capital, has important implications for wealth accumulation and distribution. In societies where money is stable and maintains its purchasing power over time, people can accumulate wealth by saving money. But when inflation erodes money's value, wealth holders seek alternative stores of value, including real estate, precious metals, art, and other assets that may appreciate or at least hold value relative to depreciating currency. The choice between holding wealth in money versus other assets involves trade-offs between liquidity, return, and risk. Money is highly liquid, meaning it can be easily spent or converted to other forms, but it may offer low or negative real returns after accounting for inflation. Real assets may offer better protection against inflation and potential for appreciation, but are less liquid and may be subject to their own risks. The wealthy typically hold diversified portfolios including various types of assets rather than holding all wealth in money, while poorer people have less choice and may be forced to hold what little wealth they have in cash or in basic goods, making them more vulnerable to inflation. The distribution of money and wealth in society and the relationship between money and inequality are subjects of ongoing debate and research. Monetary policy, including decisions about interest rates and money supply, affects different groups differently, with some benefiting from expansionary policies that stimulate economic activity and employment, while others benefit from restrictive policies that maintain stable prices and protect the value of savings. The effects of monetary innovations, including the development of credit markets and financial instruments on inequality, are complex, with some arguing that financial development promotes growth and opportunity that benefits everyone, while others argue that it primarily benefits wealthy elites who have access to financial markets and who can use leverage to amplify their returns. The concept of financial inclusion, which refers to ensuring that all people have access to useful and affordable financial services, including the ability to hold money in accounts, to make payments efficiently, to save, and to borrow for productive purposes, has received increasing attention as a development priority, with the recognition that lack of access to financial services can trap people in poverty. Mobile money systems that allow people to hold and transfer money using mobile phones, even without bank accounts, have improved financial inclusion in some developing countries, particularly in sub-Saharan Africa, where systems like M-Pesa in Kenya have achieved high rates of adoption. The psychology of money and how people perceive and value money is a fascinating area that reveals much about human nature. Money is fundamentally a social and psychological construct whose value depends on collective belief and trust. The paper notes and metal coins that serve as money have little intrinsic value but are accepted because people believe others will accept them. This requires a kind of collective faith that is usually taken for granted but can break down in situations of extreme crisis or hyperinflation, when people lose confidence in money and refuse to accept it or demand payment in alternative forms like foreign currency or goods. Psychological research has shown that people often think about money in irrational ways, violating the principle of fungibility, which says that money is money regardless of its source or intended use. People often engage in mental accounting, treating money differently depending on how it was acquired or what it is intended for, perhaps being more willing to spend money that was won or received as a gift than money that was earned through work, even though rationally these should be equivalent. The pain of paying, which is the psychological discomfort people feel when parting with money, varies depending on payment methods, with cash payments causing more psychological pain than credit card payments, which in turn cause more pain than various forms of digital or mobile payments. And this affects spending behavior, with people often spending more when using payment methods that reduce the psychological pain of paying. Loss aversion, which is the tendency for people to feel losses more strongly than equivalent gains, affects how people think about money and financial decisions. The endowment effect, where people value things they own more than identical things they do not own, can affect financial decisions and market behavior. These psychological factors mean that people do not always behave as the rational, profit-maximizing actors assumed in some economic models. Understanding the psychology of money is crucial for understanding real-world economic behavior. The ceremonial and symbolic uses of money beyond its purely economic functions are also worth noting. Money often plays important roles in social rituals and relationships. Gift giving, for instance, frequently involves money or money-equivalent gifts. The amounts and forms of these monetary gifts carry social meanings and help establish or maintain relationships. Think about wedding gifts, birthday presents, charitable donations, and various other occasions. They all involve giving money in ways that are governed by social norms and expectations. In some cultures, money is even given as part of marriage ceremonies or other life cycle rituals. The display of wealth through consuming expensive goods can serve as a form of social signaling, demonstrating one's status and success. Money can also be a source of power in relationships, affecting how decisions are made and how resources are allocated within families and other social groups. The term power of the purse perfectly reflects the idea that controlling money gives a person control or influence. These social and symbolic dimensions of money remind us that it is not merely an economic tool, but is deeply embedded in our social relations and cultural practices. Religious and ethical perspectives on money and wealth vary across traditions, but they often share concerns about the proper uses of wealth, the dangers of greed and materialism, and obligations to share with those in need. Many religious traditions have teachings about usury, which is the charging of interest on loans. Some traditions even prohibit or limit interest, viewing it as exploitative. Islamic finance, for example, has developed banking and financial practices that comply with Sharia law, which prohibits interest, using alternative structures like profit-sharing arrangements instead. Christian traditions have historically been ambivalent about wealth. Some traditions emphasize asceticism and poverty as spiritual ideals, while others have embraced wealth as a sign of divine blessing or as a resource to be used for good. The Protestant work ethic, famously identified by Max Weber, emphasized disciplined work and frugality. Some credit this mindset with contributing to the development of capitalism. Buddhist teachings, on the other hand, emphasize non-attachment to material wealth as part of the path to enlightenment. Philosophical questions about the relationship between money and happiness, what constitutes a good life, and the proper place of economic concerns in human life have been debated throughout history. Modern research on happiness and life satisfaction has found complex relationships between money and well-being. Money does correlate with happiness, but only up to a point, the point that covers basic needs and provides security. Beyond that level, the returns diminish significantly. The saying that money cannot buy happiness is both true and false true, in the sense that money alone is not sufficient for happiness, and that beyond a certain point, additional money adds little to well-being, but false, in the sense that lack of money and the resulting inability to meet basic needs clearly reduces well-being, and that money can buy things and experiences that contribute to happiness. The environmental impacts of monetary and financial systems are receiving increasing attention as awareness grows about climate change and environmental degradation. The pursuit of endless economic growth that is encouraged by monetary systems where borrowing and lending depend on expectations of future growth, and where inflation requires continuous increases in the money supply, may be incompatible with environmental sustainability on a finite planet. Alternative economic models, including steady-state economics and degrowth, challenge the assumption that economic growth should be a primary goal. Green finance and sustainable investing seek to channel financial resources toward environmentally sustainable activities and away from activities that harm the environment. Carbon pricing, through carbon taxes or cap-and-trade systems, attempts to incorporate environmental costs into market prices. Central banks are beginning to consider how climate risks affect financial stability and how monetary policy might need to account for environmental factors. The future monetary system may need to evolve to better account for environmental limits and sustainability concerns. Possible future scenarios for money and monetary systems include various developments that are difficult to predict but worth considering. The increasing digitization of payments and finance will likely continue, with physical cash becoming less important and perhaps eventually disappearing entirely in some societies, though cash will probably persist in some contexts and regions for the foreseeable future. Central bank digital currencies may be implemented by many countries, potentially transforming how money is created and distributed and how monetary policy is conducted, but the specifics of CBDC design will matter greatly for determining their effects. Cryptocurrencies and other private digital currencies may continue to evolve and could potentially become more mainstream if they can overcome current limitations, or they may remain niche phenomena used primarily for speculation and for specific purposes, like transferring funds across borders. The dominance of the US dollar in the international monetary system may persist or may gradually erode as other currencies, including the euro and the Chinese yuan, play larger roles, or as new forms of international money emerge. New technologies including artificial intelligence, blockchain, beyond cryptocurrencies, and biometric authentication may transform financial services and money in ways we cannot fully anticipate. There is no question that these functions of money as a social technology for exchange, storage, and measuring economic value will endure even if the particular forms and technologies of money continue to change. And so, we have come in all our respect with its exhaustive treatment of money from commodity to electronic and possibly digital, with discussions ranging through the history of coinage and paper, through international monetary relations, through environmental sustainability and financial inclusion, with attention drawn to philosophical questions about what money ought to be, to this appropriate summarial finish, a CD fatigue ready for sleep. The particularities of Byzantine solidi and medieval banking and fractional reserves and hyperinflation and cryptocurrency mining blend together in a comforting mist of information, not because any is urgent or emotionally engaging, but rather because this is all just history and economics clamoring for your attention on their way through you towards sleep or a break, dragging away accumulated concepts with them like the banks of a river pulling gently at your body as they ease it further downstream. What the long history of money evolving from shells and grain into abstract, digital bits that navigate computer systems becomes, in this sense, is its own kind of metaphor for time, not so much one that records linear time as it does the slow accretion of changes over time that reshape a society while individuals live out their lives unaware of these vast impersonal currents until historians come along and chart the broad patterns and shifts. And as you drift off now with pictures of ancient coins and medieval merchants and modern central banks, future digital currencies floating in your fading awareness, no need to remember much, if anything, about any of this. You can just let it float away down a gentle stream into the haze behind your eyes and get some rest. Thanks for watching. Don't forget to like and subscribe for more videos. Your support means the world to me and helps the channel grow. See you in the next one.